Hey everybody, the S&P 500 and Nasdaq are hovering near their record highs, and it might seem like the stock market is getting expensive. That is certainly true in some cases, but there are some bargains to be found. Tyler and I are going to be talking about two stocks that are still well off the highs. And before we dive in, please take a minute and check out the link you see on your screen for a message from my sponsor, The Motley Fool. You get the top 10 stocks to buy right now, and it's a great way to support this work we are doing. So, Tyler's going to talk about a company that I know pretty well. Um, I'm a big believer in solar energy. This was actually the first company I ever wrote about for the Motley Fool. A fun fact that was a while ago. And I used to own the stock. I don't anymore, but I used to own it a while ago. I remember it being very volatile. So, Tyler, talk about the stock, its volatility, and what you like about it right now.
Yeah, it is a very volatile stock. It's First Solar, the utility scale manufacturer of solar panels based in the United States. No joke, it is a cyclical industry. As much as everyone thinks that solar is a growth industry, which is true, overall demand is growing over the long term, but it is an industry that is just woefully stuck in the ups and downs of a cyclical industry because even when you have a secular tailwind of growth, if you produce too much of that than the actual demand, you're going to see huge declines in prices. And this is kind of an industry just in general that's been moving down the commodity price curve very, very quickly. First Solar has done a spectacular job of staying ahead of that. They're one of the lower cost providers, just even though they are United States based, which typically that normally means you're a little bit higher cost relative to like Chinese commodity panel manufacturers, but they have a very unique method that's a little bit different than other solar panel makers that makes it a unique and more transferable international to the US and international. So here's what's interesting to me. The stock is down about 24% compared over the past year or 12 months. What I think obviously higher interest rates has been a big part of that because project financing is higher and therefore some projects may not be as lucrative as they were. However, I think there's another component too where we're seeing a lot of weakness in residential solar deployments right now because people aren't doing rooftop solar for those very reasons, higher financing costs. However, First Solar is much more of a utility scale producer. Mostly they're the ones that are doing the, you know, several hundred megawatt farms, solar farms are utility scale. And it's a much more predictable business in terms of pipeline backlog, things like that. And this is where it really gets interesting for them is that in 2023, I think they produced somewhere between 11 and 12 uh, gigawatts of power capacity in terms of total deployments in the year for 2023, and yet their backlog is over 80 gigawatts. So they have more than 6 years of production capacity already just sitting on the books, ready for waiting for clients, waiting for them to actually do that. And as a result, this is one of the very few times that First Solar has really kind of mashed on the growth accelerator for quite a while. They've been one of the companies that is more well known to be conservative about we're not ready to build out. We're not ready to build out. We want to be sure that the market is there for that. And obviously, with 6 years worth of demand, it was time to do that. And so between 2023 and 2026, they expect to go from full manufacturing capacity of about 16 gigawatts to 25. So we're talking almost a 50% increase in terms of total production capacity over the next 4 years. And again, with that built-in sort of backlog, that's looks like sales are going to be pretty robust throughout that entire time. Um, with all of this in mind, it looks like one of those kind of businesses that's being swept up in all the bad news of something that's only tangentially related to it. And if and yes, there is obviously the pricing of those panels could fluctuate and profits may not be as robust. But all things considered, with that much production ramp coming in the next couple of years, that much project backlog in place, and I don't want to base a lot of investment thesis on politics, but with a lot of the federal spending programs that we have, like the Inflation Reduction Act and kind of these green energy spending initiatives that are putting an emphasis on U.S. based products, and there are tariffs typically associated with foreign products, it makes their offering that much more attractive. And obviously they're going to have a little bit of that kind of pricing uplift as a result. And so with that, all of those things in mind, it looks like First Solar is kind of one of those companies that is beaten down for probably slightly illogical reasons, and over the next couple of years could benefit immensely. And that's why I'm really looking at it. It's something that could be interesting over the next couple of months.
Yeah, I have one that I'm admittedly on the fence about. Yours sounded a lot more convincing than I'm about to sound, if I'm being totally honest. So mine is a company called Lemonade, and our good friend Jason Hall got it back on my radar. Well, it's always been on my radar, but got it back on my buy radar this week after its earnings report. The stock went down about 20% after earnings. If you're not familiar, Lemonade is an insurance company. Its core products have been homeowners and renters insurance. That's kind of how it's landed customers over the years. It also offers pet insurance. It offers life insurance, and most recently it has added car insurance, which is just gradually rolling out in different states. The rollout for that has been a little bit slower than I'd like to see. Lemonade is down more than 90% from its all-time high. To be perfectly honest, it shouldn't have been that high in 2021. It was one of the, got kind of caught up in the meme stock days, if you remember those. But it is beaten down from recent highs too. So just kind of looking at the numbers, the company beat expectations on pretty much all sides in the fourth quarter. It beat analyst expectations on both the top and bottom line. Lemonade doesn't really think that quarterly revenue or quarterly earnings per share really tell the story of its business. And to be fair, they really don't for insurance companies. So it provides guidance on things like in-force premium, adjusted EBITDA loss, which backs out things like stock-based compensation, which is another conversation. But when you look at their guidance for in-force premium, they handily beat that. It was up 20% year over year. Adjusted EBITDA loss, they were projecting a loss of $42 to $44 million. The loss came in at $29 million, so a little bit better than expected. Gross earned premium, which, by the way, the difference between in-force premium and gross earned premium is what they wrote in this quarter. In-force is just like the total of the insurance they're providing right now. Operating expenses were down 5% year over year, despite some growth, which is why the adjusted loss was better than expected. On a net GAAP basis, they lost $42.4 million, not stellar, but still better than the market was expecting. They're expecting further revenue growth of about 20% in 2024, and the company has recently started to actually give some profitability projections, which path to profitability was inconceivable for this company just a few years ago. They were kind of in growth at all costs mode, but now they're really focusing on efficiency. They're expecting to be cash flow positive by late 2025, so by the end of next year, and adjusted EBITDA profitable by 2026, or in 2026. They have about $945 million of cash and equivalents on the balance sheet, and the market cap is just $1.1 billion. So the market's not putting a whole lot of value on this business. They should have, if they could hit those two profitability targets, that should be plenty of cash to get them there. A couple of things that kind of scare me about Lemonade. Yes, the numbers looked great in the fourth quarter. The loss ratio, which underwriting's been a big struggle for them, they want to get their loss ratio down to about 75%. It came in at 77%, which was much improved from 89% a year ago. But the fourth quarter is a historically easy time to make money as an insurance company. Same with the first quarter. When do most natural disasters happen? During the summer. So the second and third quarter are the real trouble spots. That's when we've historically seen Lemonade's loss rate spike over 100% if they have a lot of disasters and things like that, which means that they are not underwriting that well. So the third and fourth quarter, or the second and third quarters rather, of this year are going to be what I'm watching. And not only that, management said, okay, we focused on efficiency last year. Now we're going to get back to growth mode. I think they're a little early to do that. I would prefer to see them focus on efficiency until they get those losses under control. You shouldn't be losing money in this kind of environment and saying, okay, it's all full speed ahead. Their stock-based compensation is expected to be another $60 million in 2024. Again, for a company with a market cap just over $1 billion, 60 in stock-based comp for a company that's not really doing that well with underwriting and things like that. I'd rather see them reward profitability. If you want to give them $60 million of stock-based compensation when they make $1 billion in profit, I'm all in favor. But right now, what are you rewarding? And that's kind of the discussion that Tyler and I have had a few times. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.